Welcome to the Commercial Real Estate Report. Today we are talking about the most important story in real estate for the next decade, maybe. Joining me today, she's been in commercial insurance for 17 years, just started her own business, ATW Advisors. We'll talk more about that later in the show. Skylar Romines. Skylar, welcome to the show. It's great to have you.
Thanks, Chris. I appreciate you having me on. Glad to be here. Glad to talk about insurance, everyone's favorite thing to talk about.
Somehow you are making it sort of, I don't know if I say fun again or what, but it's obviously not typically a fun topic, but you're doing a great job lighting it up and making it intriguing, to say the least.
I appreciate that. I think it's so needed in our industry. We kind of have this reputation for being this like boring, slow to move, older industry. And I think we really need, there's only so much that we can control within the insurance industry, but even if it's going to suck a little bit, we might as well have a little bit of fun with it, right? And at least, talk about it in a language that is plain language and people understand, which I think is one of the biggest complaints that I hear about insurance too, is like, people just don't know even what you're talking about sometimes. And in fairness, I have a habit of doing this sometimes too, where I'll go down the insurance rabbit hole and start using insurance speak. And people are like, okay, you lost me there. I don't even know what you're saying anymore, right? Like we have this different language that we speak. And so I think just being able to joke about it a little bit, because it does suck a little bit right now. There are solutions that we can look into, but for the most part, the market has been tough. And I think everyone's kind of aware of that by now, but just having open, honest dialogue about it is so important. And breaking down those barriers, there's such the information access in the insurance industry is so asymmetrical, where the carriers have access to so much more information typically than the buyers do. So I think it's so important to just keep having these conversations and, hopefully arm the end purchaser of insurance with enough information to be a better purchaser so that they're not stuck. Insurance is a funny industry because it's one of the only things that you kind of have to buy. And a lot of times the buyer doesn't even know what they're buying. They don't even know if they're getting a good product or not. They don't even know how to vet that. And they typically feel like they don't have a lot of control over the pricing, which is true in some sense. And I think a lot of people can be more proactive and get more control over their pricing. But yeah, so it's something nobody wants to buy, nobody's happy with, and they're generally spending way more money on it than they want to. So that's always fun to talk about. You basically get to be the Grim Reaper going into every meeting, right?
I'm so glad that you're saying all this and not me, because I think I'm reading everybody's mind. But you know what? You bring up a great point. Maybe you and I will start a series here. We'll call it Insurance for Dummies from the Commercial Real Estate Report. Just kind of lay it out and help people solve problems and get educated. So what's perfect, and this is such epic timing to have you here today, because you and I we've had you booked now for a couple of weeks. Mm-hmm. And then Monday, this gentleman from Scholastic Capital put out this tweet: insurance will be the biggest story in real estate, basically for the next decade. And I was like, oh my gosh, this is great, because Skylar's going to be joining us on Wednesday. So I guess a few things here. Number one, do you concur with that tweet? And if so, why?
Yeah, I'm glad he said it and not me, right? Because whenever I say something like that, it seems a little bit self-serving. I typically say for the next 3 to 5 years. We've seen over the last couple of years, insurance is the fastest growing expense line item in commercial real estate. And in many cases, it's increasing to outpace rent growth. So in other words, like to make it as simple as possible, it's killing deals. Like if you are not being proactive about your insurance, it will kill your deals, period. You have to talk about it. You can't. Insurance has been like this boogeyman, this dirty word that people don't want to touch for so long. And now it's like, if you keep sweeping it under the rug, it's going to keep rearing its ugly head and being more costly for you. So you have to kind of face this demon, so to speak, and deal with it head on, or else you're going to be in a lot of pain. But yeah, I do think, just because of the length of market cycles in insurance, I've been saying 3 to 5 years, and maybe I've been being too kind. But at least in the next 3 to 5 years, there are going to continue to be challenges. And I think for him to say 10 years is not unrealistic. I think it's going to continue to be something where, there are challenges in the insurance market. There are also challenges with the end buyer of insurance. I truly believe, and I've talked to more and more people who are starting to shift to this mindset as well, both inside the industry and outside of the insurance industry, where yes, we can talk about these traditional market cycles and we can see, a lot of standard indicators, and none of this is really new. What I think is changing is we're kind of going through this massive shift in insurance, where there truly is this old way to purchase insurance this new way to purchase commercial insurance. And I think those folks who are stuck in the old way, which was really kind of to be a passive purchaser, right? Just hire your broker, deal with whatever they send to you. What I hear often from clients and friends who own businesses as well is, so we fill out our paperwork every year, we send it off to our broker, it goes behind this magic curtain of insurance. We have no idea what's going on for a couple of months, and then we get a quote back a week before our renewal, and we just have to kind of deal with it, right? And that's frustrating. I mean, just listen to that process. It feels like you're pushed with your back against the wall and you have no options, right? And so I think that truly is for most people. Now, some operators are and have been more proactive about insurance procurement. I think that will continue to be the norm. We're going to, obviously I have a vested interest, so I'm a little bit biased here, but I think that the people who start making insurance more of a priority, it's going to be, especially for real estate operators, it's going to be something that really sets people apart and gives you a competitive advantage in the real estate market over the next 5 to 10 years.
Which is why you started ATW Advisors, which we'll talk about in a moment. But I want to get to the why on this tweet. I mean, to me, because I'm not in your world every day, this is a very bold statement. So I'm curious as to why you concur with this thesis. And then secondly, before we started, you said, hey, Chris, I've spoken to this gentleman before. Part of their investment thesis was because of the insurance costs.
Yeah. So again, I mean, I have said this line 1,000 times. I'll keep saying it until I'm blue in the face, but it simplifies everything to such a degree that if you just parse this out, I think it makes so much sense. Insurance is far and away the fastest growing expense line item in commercial real estate, period. In many cases, insurance alone is increasing to outpace rent growth. As long as that's the case, you can't be profitable. You can't have your expenses going up more than your income and have a profitable asset, right? So just breaking down those building blocks to like the most basic level, you have to reduce those insurance increases to maintain a profitable asset, period. And that's not even accounting for, your property tax increases and your CapEx and everything else that you have to deal with. It's just the fastest growing expense line item. So people have to find a way to mitigate and manage those insurance costs, or they're going to continue to move towards unprofitability, which, I mean, that's not a good business model for anyone, needless to say. So, and yeah, as far as the tweet that gentleman sent out, I've talked to him in the past. Him and his partner, part of their investment thesis is they're buying single family rental homes, mostly in the Midwest. And a large part of the reason for that, my understanding, is because they see where the insurance costs have been, outsized, I'll say. And if you kind of look at the US and kind of the smile of the United States, so to speak, so you're looking at California, parts of Texas, parts of Florida, New York, are seeing, more challenges when it comes to insurance. So they believe that buying in kind of that middle of the US area, right? That Midwest area where insurance is not such a challenge in most cases. Now, there are always exceptions, and we can get into some of that later if you want to, but they believe that that's going to be a real differentiator in terms of their investment thesis. So I thought that was really interesting. It's the first time I've spoken to someone who insurance is truly part of their investment thesis baked in. And I think, again, as insurance continues to become more of a story in the commercial real estate space, I don't think it will be unusual for insurance to be used as a competitive advantage. And I don't think that you necessarily have to shift to where you're buying your assets, right? And change your whole thesis to we're only buying in the Midwest. What you do need to do is get more proactive and build a competitive insurance program. And that needs to be something that you're making a priority. And really, I keep saying the word proactive, but you really need to be proactive about building a program versus just accepting the program that the brokers are throwing at you. So.
And I want to get into that because I'm presuming we talked briefly before, but that's kind of the impetus and the essence of what your business is now, is coaching people through this. Before we get there, though, just to speak to what the gentleman's thesis is and get your take. This is from, as you can see, the Deloitte Center for Financial Services. But they're saying, hey, by 2030 in more of the high risk areas, and if you want to tell us what those are exactly, but you're going to see your insurance, at least double is their projection.
Yeah. Looking at the chart that you put up through 2030, I think that there's probably, I don't know where this came from. Okay. Looks like Deloitte. So I think that in some cases, this will probably be true, right? Higher risk states, again, I don't know if this is property. It looks like extreme weather events. So it looks like they're referring to property insurance as opposed to general liability. I think that there's potential for this to be true. I think doubling is probably, if we're going from 2000 to 2030, that's totally relevant, a lot of people have already seen that doubling or more, right? If we're looking from now to 2030, I think for property insurance to double would be an outsized increase. There will always be, for people who have significant loss history or other challenges associated with specific assets, specific properties, there will always be a higher rate of increase, obviously, as one would expect. But I think for most people, the bulk of the challenge in the property insurance market and this hard property insurance market has passed. So what we're seeing is there's still, a bit of a challenge in some of those areas that we discussed: coastal Florida, coastal Texas, parts of California, even parts of, Colorado and that area in the hail belt, which didn't get hit with increases as hard as some people were expecting during the hard property market, which is nice. But what we're really seeing now is these leading indicators that the general liability market is going to be the next thing to shift and tighten on people. So the breakdown of who that's going to impact is different, right? Because for first party property, you're dealing with a lot of these weather events, you're dealing with loss to your asset. Third party, you're dealing with, liability, you're dealing with third party damage. So you're dealing with loss to others. So where that will break down and who will be impacted by those increases is going to look a little bit different, right? A lot of carriers now are running crime scores. So they're seeing which areas have high crime. A lot of carriers are looking at ingress and egress, who has the most, who has the public accessing their location the most, right? So who's most at risk for a slip and fall or some other type of event to occur where you're ultimately going to get sued. And unfortunately, with the nuclear jury verdicts and everything that we're seeing on the liability side, a lot of those cases are just blowing up and getting out of control. So I think a lot more the hard GL market will be based on things like, what do the tort statutes look like in this specific area? And then in terms of your property itself, how much is the public accessing your property? So think of anyone that you don't have a written contract with that could potentially limit your liability, and how often are they coming onto your property? So you look at multifamily, you're going to have a lease with most people, but even those tenants are going to have people visiting and things like that. That's a huge unknown. So that, I think, is what carriers are really starting to, if you want to look at on the GL side, what people are looking to rate for, it's those unknowns, right? So if you look at even like industrial as an asset class, it's such a huge asset class. It's so many different things from an insurance perspective, right? This could include self-storage. It could include a factory. It could include, an industrial park with a trampoline park inside of it. And so you have that trampoline park that changes things significantly, right? Because now you've got people coming in and out all the time with the potential to get injured. And maybe you're having them sign a waiver. Hopefully you are, right? But those things aren't bulletproof. So still a decent likelihood that you get sued. And what people tend to forget, or one thing that people tend to forget in terms of insurance, is if you get sued, even if you ultimately have no liability, you have those defense costs to worry about, right? And that's not cheap. Defense costs can get to 6 figures in no time flat, and sometimes can get into 7 figures or even higher. And so you definitely want to make sure that you have insurance in place that's going to defend you in the event of a lawsuit, even if you ultimately are not liable for the claim.
I think what's fascinating too, and you touched on a couple of things, but insurance companies now have got access to so much information that it isn't the best way to say this, but you feel like they almost have you by the throat. So what do you do? And how are they now taking all this data, especially with AI, and coming up with a fair assessment for an insurance rate?
Yeah, I mean, the best thing that you can do is arm yourself with information as well, right? And make sure that you're being competitive against your peers versus competing against the insurance company. So this is another shift that I think we're seeing in terms of how insurance procurement is handled, where yes, we know that there's asymmetry of information, but I think that's actually becoming less and less, right? Because more people have access to tools that will give them the same types of information that insurance carriers have had for some time. But in the past, there's also kind of been this mindset of, well, it's us versus the carriers, right? We need to negotiate the lowest rates. The carrier is kind of the enemy. And now, as we shift to this harder market cycle and there's less capacity, you have to think about it more like you're competing against your peers, right? So the carrier is actually your partner in this transaction. We want to get the best rates and the best coverage from them, and capacity is limited. They're not desperate to write insurance like they were 10 years ago, right? A little anecdotal thing that I share with a lot of people is I had a lady who was working with us at one point who was newer to the industry, and she was asking me, just kind of trying to get a feel for everything, right? Brand new to the industry, college grad. And she was saying, when we go out to lunch with a client, we pay. When we go out to lunch with an underwriter, this is in my time as a broker, who pays? Is it us or does the carrier pay? And I said, succinctly, 10 years ago, they would have paid. Now we do, right? We need them more than they need us. So, kind of a little anecdotal quip, but that balance and power shift really has occurred where the people who tend to be getting the best results are the people who know their underwriters, right? That's one thing that we always advocate for our
Wow.
clients. Meet your underwriters. Don't just meet your underwriter, but know in the next 2 to 3 years, let's say you're a multifamily operator and you're with ABC Insurance Company and they pull out of multifamily entirely, right? Their underwriting requirements change. They just decide they're not going to write that class of business at all anymore. So they're no longer going to write your insurance. You want to know who's on deck and who's third, right? You want to know who's coming up in the lineup, who's going to be able to write your insurance if that carrier pulls out. You don't want to be stuck with that 60 or 90 days ahead of a renewal and scrambling to figure out your next option. You want to start building those relationships early and checking in with them often to make sure that, hey, if this falls apart, we have this other option lined up. And not only that, but we already have this relationship built where they know us, they kind of have started to build trust with us. And again, look at it as you're competing against other operators in your space, you're competing against your peers. So a big piece of this puzzle now is just storytelling. Again, access to all of the data, getting as much data as you can, A, so that you can package it nicely to present it to the carrier, but B, so that you're ready and, kind of have to do a little bit of an assessment, be honest with yourself about where you maybe have some adverse risk so that you can get out in front of that and without being dishonest, paint it in the nicest light possible because the carrier is going to ask about certain things if they pop up, right? Carrier has access to real-time satellite imaging. They're going to pull up your property. If there's one thing we've seen, unfortunately, a lot more lately the last few years, is like a homeless encampment down the street. Well, that's a risk for you, right? There could be a fire started. We've seen other issues with those types of things. So if you know that's going on down the street from you, don't wait until the carrier pulls it up and sees this. And then they either ask questions or maybe they don't even ask questions. Maybe you don't get the opportunity to explain. They just send out a declination, right? You don't want to put yourself in that position.
Right.
You want to be as proactive as you can, giving them an executive summary, letting them know if there are any adverse risks that you're aware of. Hey, we know this is happening, but we're doing ABC to try to fix it. And here's our timeline on fixing it. And can we partner with you on some things? Because a lot of times what people don't realize too is if you're willing to put time and money and energy into risk management, carriers will work with you on that. A lot of times they already have standard procedures that they'll share with you. A lot of times they'll even help pay for certain things, right? Whether it's the telematics that go into vehicles or, the range queens is the terminology I've heard for it, but that go above the stoves, right? There are certain things that some carriers will partner with to either pay a percentage of it or give you a reduction in premium if you implement those things. But if you're not having that open, honest dialogue with your carrier partners and your broker partners, then you don't even know what options are available. And I think a lot of people just don't even, again, think of that because they're so used to just waiting for the quote to come in and they think you get what you get and that's it, right? And it doesn't have to be that way.
So what I'm hearing you say, and tell me if this is a fair analogy or not, but it's sort of like building a relationship with your banker. I mean, for example, like we had a site, got appraised, we didn't agree with the appraisal. And so we went back and said, hey, wait a second, here's what we believe, and had a chance to sort of change the appraisal. So is it something similar now with my underwriters? I want to build those and is that where you come in, where I'm building these relationships and we try to work together to create the best underwriting for both parties?
Yeah, I mean, ideally, that's a conversation, right? It's a dance. It's not them throwing something at you and you catching it. It's you guys working to find the best terms at the best pricing and figuring out why they've priced something the way they have. Because that's another thing that's really interesting about insurance is a lot of people I find don't even understand what their rating basis is or why the premium went up or what's going into that underwriting process. And so sometimes just having those conversations and understanding, well, hey, on this side, here's where your liability premium increased because of this. Here's your property increase because of this. What can we do if we want to reduce the overall cost of risk? Is it taking a higher deductible? Is it structuring the program differently so that you're taking on more risk outside of insurance risk transfer, right? Or is it restructuring within the insurance policy and the terms in a way that we can reduce the premium? Or is it putting more money, more energy into risk management upfront so that you're not considered an adverse risk so that premiums can be reduced that way, right? So there's so much, a lot of people tend to think that insurance is like a formula and hey, shouldn't it be easy? It's just this times this. And to a degree, I mean, at a very basic level, yes, it can be, but so much of it is subjective, right? There's underwriting credits and debits. There's so much that you can do to kind of massage that premium. If it was just a simple formula, everybody would know what their insurance will be next year and the year after. And that's obviously not the case for a reason, right? So there are so many different things that go into reaching that final premium. And if you don't understand the process and don't have the information to arm yourself with, you're stuck in a terrible negotiating position where you have no leverage now because not a lot of carriers are coming to the table. And so you can't really pit them against each other like you used to in the past. The other thing is, carriers are getting asked for more and more detailed information from their reinsurers. So if you can make the carrier's life easier by providing them as much information and in a clean and easy to digest manner as you can, you're just going to be in a better position. One statistic that's been floating around recently is that underwriters in this hard market are reviewing in detail about 30% of the submissions that they receive because they're just inundated with submissions now versus 5 years ago. Right. And so that's what I talk to my clients about too, is like, how can we package the submission to make sure that you're one of, because it's piles of paperwork, or now it's, emails, mostly it's digital, may not be piles of paperwork on your desk. But if you're thinking about all these emails, all these papers that they have to go through, and underwriters really have to dig in at a really high level into all of this data, right? If you can just make it easy for them and hand it to them, the fewer questions they have to ask, the less they have to dig into the information and try to put pieces together on their own. We don't want them putting pieces together on their own, right? We want to kind of just hand them the completed puzzle and say, look, here it is. How can we make this work? Versus you have to go dig around, because if they have to go dig around and try to make it work, the odds that they're going to do that, again, being in an environment where, especially when underwriters used to have quotas where, hey, we need to write X amount of new business a month. Now, a lot of the times it's the opposite, where it's, hey, we can only write 5 or 10 new real estate accounts, right? Or we only want this much revenue that's based on this asset class or coming from this asset class. So you have to find a way to be competitive and be one of the most desirable risks so that you can get that capacity, versus looking at it like, hey, we're going to have all these options. That's soft market world. It's different now. So that mindset definitely needs to shift towards finding ways to be a more competitive purchaser, which is, an interesting way to look at it, but that's really what works in this world.
So what asset classes do you see are being hurt the most? Which ones still maybe have some breathing room? Like, kind of walk us through the different asset classes in CRE and what you're seeing.
Yeah, so I think it's probably no secret to most people that multifamily has been hit the hardest with insurance costs over the last few years. Unfortunately, as we see this tightening general liability market, I think that will continue in some cases. I think it depends a lot on where you're located too, right? What we've seen on the GL side already is a lot of carriers are pulling back on coverage. So things like habitability claims, things like assault and battery, things like abuse and molestation. If you think about having, again, so many people, your tenants, their friends, their family, whoever coming in and out, in a lot of cases, we see claims where maybe there's a domestic violence incident, but it's on the site. Well, did the operator really have anything to do with that? No, not really. But are they going to get named in the lawsuit? Yeah. So you need to have insurance to defend for that, right? And so we're already seeing carriers kind of pull back firearms exclusions, again, abuse and molestation, assault and battery, things like that. So you need to really make sure that you're not only looking at your pricing, but looking at your coverage, because if you can save, 50 grand a year on your premium, but you don't have any assault and battery coverage, and then you have one claim that's a couple $1,000,000, you didn't really just save any money at all. You just put yourself on the hook to pay that out of pocket. So you may have reduced your premiums, but you've increased your balance sheet risk tremendously, right? And so those are the kinds of things that people need to be looking at too. So multifamily has definitely been hit the hardest, but I think there's a lot of opportunity in that space as well. We've definitely seen some shared limit property programs pop up, things like that. And there's so much opportunity to do your building updates, to be a good operator. We're seeing things even on the liability side, implementing things like, hey, if you're in a high crime score neighborhood, people are putting in cameras with license plate readers on them. It's not that expensive to do, but it's something where if a crime occurs and you're getting sued, it's going to be much easier to find who did it because you've got this plan already implemented in place, right? So again, just little things like that where you can be proactive on the front end is going to help your insurance experience on the back end. Office, rates are relatively low compared to other asset classes. They've had their challenges over the last couple of years with vacancy issues. And so hopefully everyone by now is kind of aware of what's going on in that space, that it's important to talk to your carrier about your vacancy clauses and make sure that if you get to a certain percentage of vacancy or below, sometimes they'll work with you and waive that vacancy clause for the remainder of your policy period. That's ideal. If they're not willing to do that, you need to understand what your vacancy clause is and how that's impacting your coverage. Because a lot of times what it will say is if you get under X amount of X percentage of vacancy, we're no longer covering for, theft, vandalism, the types of things that become a risk when nobody's in the building, right? But if you're, 30% occupied and people are actually on site every day, and even if you're not, what I tell my clients is have a property manager, have someone go walk the asset every day and just be there. A lot of times your carriers will work with you, especially if they see that you're trying, right? So again, it's a conversation to have. It's all about that open communication back and forth. But what you don't want to do is, not tell your broker, not tell your carrier, your insurance team has no idea what's going on. Hopefully they're asking. I mean, they're probably asking for rent rolls every year, so they should have some idea of where your vacancy rate is. But if there are any significant changes, big tenant moves out or whatever, you want to make sure you're having those conversations and maybe you can work with it, right? It doesn't have to be, if you don't have the conversation, you're absolutely bound by the four corners of the policy, right? If you can have the conversation and make a change, maybe endorse it, maybe just get them to confirm that, hey, in the event of a loss, we're not going to implement this vacancy clause. There are a lot of things that you can do. What else? Retail has had it relatively easy, right? I'll say that with the caveat of if you've been in high wildfire California, again, those coastal areas in Texas and Florida, if you have some geography challenges, that's not the case. But unfortunately, I think retail will be one of the asset classes that's hit the hardest as the general liability market, tightens and restricts. Reason for that being, again, you have kind of just this unfettered access to the public where you can't really control for those potential losses. So someone slips and falls. I mean, some of the claims you see over the years are just so ridiculous, right? I've seen slip and fall in a parking lot where they claim that the freshly painted red curb was too bright red and the sun hit it and blinded them. And so they slipped and fell, right? I mean, you see things like that where it's just insane, right? But then, in a lot of locales, the carriers don't even want to go to court anymore because they've seen what the jury verdicts look like. And so certain carriers will say, hey, in this county or that county, we settle everything out of court. And then that becomes a vicious cycle as well because people start to hear that and they understand that. And so those attorneys know. And if they see, hey, you've got, carrier A who we know won't go to trial in this county because they've had really poor results with jury trials, they're going to push for a higher and higher settlement, right? And so all of those, I think a lot of people who are not actively in this space look at insurance carriers and they think, oh, well, they have these billions of dollars, they're not going to be impacted by paying out these $1 million claims when they have billions of dollars. Well, to some degree that's true, sure, but there's always a trickle-down effect, right? Where they don't just have endless funds where they're going to keep paying and keep being profitable. And then it's amazing to me how a lot of people don't seem to understand, like when you're not happy about your premiums going up, this is one of the reasons why, right? When carriers are paying out more and more dollars in claims, your premiums are going to continue going up. So there's, challenges there as well. And then
go ahead.
I was just going to say, and then industrial, we kind of talked about earlier. I think there's a clear bifurcation of industrial where if you have high risk activities, like, the trampoline park is kind of the traditional example. If you've got maybe a gun range, if you've got, these things where you have people coming in and out, there's a high risk activity going on, expect your general liability rates to go up significantly. I've been kind of beating this drum for the last several months because just kind of as the insurance nerd, I've seen leading indicators, but now we're starting to actually see conversations being had where reinsurers are saying for the US market, we're seeking double-digit general liability increases for that January 1, 2025 reinsurance renewal. And then, double-digit reinsurance renewal increase means that you're looking at even more than that on your insurance increase. So really poor leading indicators in that space. So again, hopefully people's insurance teams are having this conversation with them. But if not, reach out to your broker, reach out to me if you need to, but definitely be preparing for A, potential increases, and B, what can you do again to make sure that you're best in class, to make sure that you are having multiple carriers who are willing to come to the table so that you have options and you can drive down those premiums versus just being at the mercy of the insurance market.
One note I'll make is you did not mention self-storage. So self-storage,
Sure.
lesser risk these increases in insurance?
Yeah, I would say so. Self-storage in terms of insurance, there's just not a huge story there,
Yeah.
right? I've seen kind of some anecdotal things online, mostly on social media, where people are moving out of their apartments and trying to move into self-storage units. That's terrible optics. I'm sure that's not going on at scale, but the people who are posting that on social media are really doing a disservice in terms of, underwriters will get scared of anything. So I think things like that are probably not helping. But again, as long as you're having those conversations and you're showing that you have proper risk management procedures in place, I don't see any reason why self-storage in particular would get hit harder with the GL increases than other asset classes.
Two more questions to be respectful of your time. One is,
Yeah.
if you were queen for a day or a year, how would you solve this insurance situation in our nation?
I mean, I don't think we have time to to discuss that, right? I think there are a lot of different paths that you could go with this. I think that building stronger buildings that are less susceptible to harm is huge on the property side, of course, especially because we continue to see more severe weather events. We had, I think, 10 over $1 billion individual weather events in 2023. And if you look at what that chart looks like, it's going up every year. It's not changing. Of course, that's partially impacted not only by the severity of the event itself, but by the increasing property values. So you're getting hit on both ends with that inflationary.
Yeah. I mean, because I think where you're going is great. And yet, again, from an NOI investment standpoint, like, okay, I build a stronger building, my construction costs go up. So maybe I lower my insurance premiums a little bit, but now I got
it's true.
It's just it's such a challenge to figure out how do I continue to make this business and these asset classes profitable. I didn't mean to interrupt you, but I think just a caveat to consider.
Yeah, no, it's absolutely true. And as most people have figured out now, at your replacement cost valuation or ACV or whatever your property is valued at based on your insurance policy is your rating basis. So as that goes up, your rate goes up, in line with that. And that is just the way that it is. So your rate times your rating basis divided by 1,000 is going to be your premium. So pretty simple insurance math there for you. Yeah, I mean, there's no quick and easy solution to this. I see a lot of people saying like, we just need government backing for all of the insurance. No, we don't. I promise. Like that may on its face sound like a nice solution. That's absolutely not the solution. I mean, I think if you look at the insurance crisis in California and how that's shaking out with the governmental entities being way too involved in the homeowners insurance market and how that's gone, you can see pretty quickly that it creates a much more inefficient market. And in the end, that's going to be more expensive for everyone as opposed to less expensive, both in terms of you're paying in more and you're getting less coverage on the back end.
I think you emailed me about cedants, which I'm not an expert in, but like, I'm going to use that as an analogy. Is there some sort of program potential? Like you see some of these nonprofit Christian medical insurers, right, that seem to do a pretty good job as far as mitigating costs, keeping people insured. Is there some kind of pool that business owners could create themselves, or is that just sky in the pipe thinking on my part?
Yeah, I mean, in certain types of businesses, it's not unusual to see a group captive, right? So a lot of the trades, you'll see group captives that exist.
Okay.
Now, this is where it gets a little funky for a lot of people, is everybody wants to believe that they're the best and the greatest, right? But when you really look at your losses versus your premium, those group captives, for obvious reasons, want to take in the least risky partners, right? And so group captive by definition is going to be your best in class operators who have the least risk typically. And then you're going to pay in based on your amount of risk. So it's not that different from the carrier, except you have kind of these desirable risks in a pool. So you may pay in less, and then you're going to get less on, or you're going to get refunded back on the back end if you don't have claims, et cetera. So there are benefits to that. Historically, in the commercial real estate world, you don't see as many group captives. We can all take our guesses as to the reasons for that, whether it be that operators just a lot of times don't want to be pooled with other operators, right? We are definitely having more and more conversations about these single parent captives. So people setting up their own captive insurance company and relying on that versus relying on the traditional insurance market. I think those trends will continue. We see that especially, a lot of family offices are having those conversations, a lot of larger operators who have the balance sheet to support it, but still have, a relatively high risk appetite, because obviously, you are taking on some risk in the first few years as you're funding that captive that's outsized compared to the traditional insurance market. We're also seeing, solutions like renters insurance captives on the multifamily side, where you don't have to put everything into a captive right away, but these multifamily operators are starting to put renters insurance captives together. So they're funding this pot, and then that becomes a revenue source on the back end, where now you're taking in the premium versus another, third-party insurance company. So there are ways, again, like that, to make insurance a profit center versus an expense, which that's a conversation that more and more people are having, because maybe your insurance overall is going up, but you're able to set up this renter's insurance captive where you're getting back, $4 or $5 up to $8, $9 per tenant on this captive side. As you build more units, that becomes a significant profit center, right? And so things like that we're seeing more often. We're definitely seeing more people push back on their lenders in terms of deductible limits. They want to take a higher deductible, and that makes so much sense in a lot of cases, right? But you have to get your lender on board. You have to have those conversations, and it's something that we're seeing things trend in that direction. I think we'll continue to see things trend in that direction. Any creative solutions that people can have where they have more control of the process and are not just at the mercy of the traditional insurance market, I think is going to continue to be more and more popular. The question then becomes, for the folks who do have issues like severe loss history, undesirable geography and things like that. It's one thing to have some assets in an undesirable geographic location in your portfolio, and you have a large portfolio and you kind of offset that with the rest of your risk. It's another thing if your thesis has been, hey, we're buying this asset class in coastal Florida for the last 10 years, right? And that's your whole portfolio. That looks different. That's a much tougher sell. So all of those things are good to consider. The one thing I will say, is over the last 2 to 3 years, more and more people keep asking about property captives. And what we see 90+% of the time is, if you actually sit down and do the math on that, once people are faced with their, maximum probable loss, and they actually see it in black and white, what they could be paying out of their pocket, they quickly realize why the carriers are charging so much, and they don't want to take on that risk themselves.
Yeah.
So there's a lot of, I think the insurance market also is a function of everything else. We talked about the replacement cost valuations. Well, that's a function of a lot of things. That's a function of supply chain issues. It's a function of inflation. So the question on that end also quickly becomes, well, when are all of our other financial system issues going to be resolved? And insurance will be, resolved to a degree as a result of that. So it doesn't exist in a vacuum. It's very much, obviously, again, I'm biased, but insurance is the great connector in a lot of ways, where it really does kind of have its fingers in everything. And then on the GL side, tort reform is a huge conversation. I mean, you look at countries like France and Germany who have a civil law system, who have, caps on payouts, who have more judicial review versus jury review, and they're not being faced with, if you look globally, the same types of expected increases on the general liability that the US insurance market is in 2025 and beyond. So, I don't think that tort reform is a huge priority for a lot of folks, but looking at some solutions like that, like caps on payouts and, reducing those nuclear jury verdicts and protecting the carriers from unfair payouts in a lot of instances, would make a meaningful difference. Is that going to happen? I don't see it in the immediate sense, and I don't have a crystal ball, but those are the kinds of things that we would need to look at to make a meaningful difference in the insurance market.
You know what, Skylar, I got to share something with you. I don't know if I've ever met anybody as passionate about insurance as you.
I hear that a lot.
I'm like, wow, like it's amazing to me. So with that being said, you recently started ATW Advisors. Like when I listen to you, I'm like, oh my gosh, there are so many problems for you to solve for clients. So if you wouldn't mind, give people an idea of kind of the impetus of you starting this business and what problems are you solving for clients?
Yeah, absolutely. So kind of offhand, one of the things that I say about ATW, one of our little like one-liner tags is insurance sucks. We can help you make it suck less. So that's kind of the whole business model in a nutshell. But, I left 17 years on the insurance brokerage side and decided to become what I bill as an owner's insurance rep. So if you look at a job site and what an owner's rep does on a job site, we want to do that for you through the insurance procurement process, right? So essentially it's a third-party consulting role, but we really act in the client's best interest as a bridge between them and their broker, them and their carriers, to build out a more robust insurance team. And obviously, again, I have a vested interest in this, but we're seeing a trend in this direction. I bet my 17-year career on it by launching ATW, I'm seeing others kind of shift more towards doing the same, but best in class operators tend to already be hiring this third party insurance consulting role. And I think we're going to continue to see that becoming more and more popular because the results kind of speak for themselves as we stack more evidence to the fact that our clients are getting better results. Other folks, and I won't say it's just ATW, other folks who have someone representing their best interest through the process tend to be getting better results as well. I think that this becomes the norm for insurance procurement versus just that broker to carrier process, because even the best brokers aren't able to work solely in the best interest of the client. They've got their carriers, they've got their wholesale brokers, they've got multiple mouths to feed, so to speak. And so when you have a party like ATW who solely represents the client's best interest, it makes a meaningful difference in the outcomes.
I mean, just listening to you, I'm just going, oh my gosh, your business must just be booming. So I hope it is.
Demand has been crazy. Yeah. I can't complain on that end. Yeah, we've been busy for sure.
And what's your tagline again? Insurance sucks. We make it suck less.
We can help you make it suck less. Yeah. Because nobody wants to deal with it, right? Get back to your core business. You guys focus on what you do. We'll focus on what we do best, which for better or worse is insurance. So
have you seen any of the marketing for Liquid Death? Do you know Liquid Death?
Is that the water company?
Yeah, water.
Yeah. I'm not really familiar with their marketing. No.
It's phenomenal.
Okay.
Your tagline reminds me of like you should go kind of the Liquid Death angle with your strategy, because that is just a great tagline. So I want to give you the last word. Anything else you want to add or share that I haven't asked you?
I think that's it. I mean, we've talked about insurance for a while now. I think everybody's probably sick of talking. Everybody's sick of talking about insurance, but on the other side of that coin is you need to talk about insurance more. You need to be proactive about it. If you don't do anything about your insurance procurement processes and keep buying insurance the old way, you're going to keep having a hard time. There's just no way around that, right? So bite the bullet, have the conversation, build the strong insurance team, do it all once, build out those standard operating procedures when it comes to insurance procurement and risk management, build those relationships with your carriers. Once you do it all once, you don't have to do it again. So it may be painful for the first year or two, but then it's setting your firm up for success going forward. So I can't stress that enough. It's the insurance is not going away. The cost of insurance is not going away. Even if we enter into a softer market, it's going to be, 3, 5, 10 years before you see a meaningful decrease in any insurance rates. So do what you can in the meantime to use it to your competitive advantage.
And I just think hire experts, right? I mean, even thank goodness we talked about insurance for dummies, because I think I said cedents and it was captives. Like, who knows all those terms, and yet you do passionately. So I think find the expert. And so I want to invite you, we put it up earlier, but if you want to check out more about Skylar and her business, go to atwadvisors.com. This is the website. Also, you can follow her on Twitter. She does a great job there with some motivational stuff, great tweets she's putting out. That's her Twitter handle. And you can always email her, Skylar@atwadvisors.com. So Skylar, appreciate the insight. As if this is the truth, if this is going to be the story for the next decade, we look forward to having you back and continuing to help you educate the insurance for dummies. Okay.
Awesome. I appreciate you having me, Chris. This has been great. And, thanks for just letting me spout off about insurance for half an hour.
Your passion for it is phenomenal. So thank you for joining us. Share this with friends, colleagues. Again, this is the Commercial Real Estate Report, empowering you to build generational wealth.